Here's the exciting scoop from the latest UK spring budget.
With the autumn reductions, it means 27 million employees will get an average tax cut of £900 a year. With the autumn
Starting April 6th, 2024, Chancellor Jeremy Hunt is reducing the national insurance contribution rate for Class 1 employees from 10% to 8%. This means those employed will pay less tax, marking the second reduction in just 6 months. So what does this mean for you? Well, it means a bit more cash landing in your bank account every month because there will be less national insurance taken from your pay. But before we dive into the UK tax system and chat about how this national insurance tax cut will help us salaried employees, let me quickly introduce myself. I'm Rachel, and welcome to Travel Abroad Migration. All right, let's dive right into it. Today we're going to dissect the income tax deductions on salaries earned in a financial year. First, let's clear up some terms: gross pay and net pay. Gross pay is your income before any taxes and deductions. It's often referred to as your annual salary. Net pay, on the other hand, is what you take home after deductions like income tax and national insurance have been accounted for. Let's zoom in on the typical UK payslip displayed on your screen and focus on two deductions: income tax and national insurance. Let's first understand HMRC, which stands for Her Majesty's Revenue and Customs. HMRC is responsible for managing taxes across the UK, ensuring that the funds contribute to various sectors like welfare, healthcare, education, and more. Now, let's zoom into the specifics of income tax and national insurance contributions. As an employee, these deductions are automatically handled through the pay system, so you don't need to worry about managing them yourself. However, it's always beneficial to know how much is being deducted each month from your gross salary for income tax and national insurance. It's worth noting that income tax bands are different if you live in Scotland, so in this video, I'll be covering only England, Wales, and Northern Ireland. Let's begin with income tax. There's a concept called personal allowance, which refers to the amount of income an individual can earn each year before they start paying income tax. It's like a tax-free treasure chest, as shown in the table on your screen. As an employee, you pay 0% tax on earnings up to £12,570. Then, you pay 20% on anything you earn between £12,571 and £50,270. After that, you'll pay 40% income tax on earnings between £50,271 to £150,000. If you earn £150,001 and over, you pay 45% tax. Now, let's move on to national insurance. National insurance contributions, unlike income tax, are not an annual tax but are applied each pay period. The threshold aligns with the income tax personal allowance, meaning you start paying NI once your earnings exceed £242 per week or £148 per month. So, if you earn less than this amount in a week or month, you won't pay any national insurance on those earnings. This implies that if you earn extra in 1 month, you'll pay extra national insurance, but you won't be able to claim the extra back even if your pay is lower during other months of the tax year. As depicted in the table on the screen, the national insurance rate you pay depends on how much you earn. For instance, it's 10% of your weekly earnings between £242 to £967 a week, or £1,048 to £4,189 a month. The NI rate will drop to 8% from April 6, 2024, further lightening the burden for employees. This means you'll save more on your NI contribution, resulting in increased take-home pay. Next, let's address some common questions about tax deductions. Question 1. Is there a way I can save tax on my salary income by making investments? No. But if you're earning money through investments like stocks, you can save tax by investing via an ISA, individual savings account. Stocks ISA dividends are a separate topic. If you wish to learn more about it, let me know in the comments section, and I'll make a detailed video explaining that. Question 2. How can I check how much money my company has paid to HMRC on my behalf? You can check online by creating an account on the government website or by using the HMRC app. Question 3. What's the difference between P45 and P60? A P45 is given to you when you change jobs. It shows your earnings and tax payments from your old job. On the other hand, a P60 summarises all your tax information for the whole year, showing how much tax you've paid and your total earnings. Question 4. I earn less than £12,500. Why is tax deducted from my pay? If you work in the UK and earn less than £12,500, you might still see tax deducted on your payslips. But don't worry, you'll get this back at the end of the tax year, which is in April when tax returns are processed. Even if you earn a taxable income, you could still get a tax refund at the end of the tax year because you may have paid too much tax throughout the last financial year. Question 5. What should I do if my tax code is wrong? You can call HMRC, HM Revenue and Customs, on the phone and ask them to fix your tax code. They're usually helpful, but sometimes you might have to wait a while on the phone, maybe even an hour. Understanding the UK tax system is important, and these changes are welcome news for employees. If you have any questions, drop them in the comments section below. Thanks for watching my video till the end, and I hope to see you soon again with my next video. Until then, keep learning.